Now I'm gonna start the section B of business valuation chapter. Here we will start this question. The Kevin Thorne. We have given one scenario, and based on that scenario, we have to answer five questions. Okay, and these are objective based questions. Okay, so you have to choose the right answer. Okay, so now let's start this question. Kevin the Thorn is an investor. So he's an investor who specializes in buying corporate debt. Corporate debt, you buy corporate debt at discounted values, okay, and aims to make gains by either selling bonds at higher value. Either they sell bonds at higher value or by receiving the redemption. Either they sell or take the redemption value. Okay, so Kevin is currently evaluating the following investment. So now the Kevin is evaluating these investments, so in the company A, B and the C. Okay, so last year Kevin bought 1 million nominal value of unquoted 5% bond in company A. So last year Kevin bought what? Unquoted, bought 1 million nominal value. So this is the bond he has bought, $1 million nominal value, and the 5% bond at a price of this. Okay, so the bonds are to be redeemed at nominal value of, so now the bond can be redeemed at, this is the redemption value, in 5 years time. But company A is showing signs of financial distress. So now company A has the financial difficulties. To value the bonds, Kevin has estimated that a return of 30% is appropriate 30% is appropriate here to compensate for the risk of non-payment. Okay, so for this Kevin has estimated the cost of debt. How much? This is the return that the bond holders are expecting to value the bonds. Kevin has estimated that the return 30% is for appropriate for here to compensate for the risk of non-payment, for the non-payment. Okay, so now the company B is a forestry company. This is another company we are going to evaluate. The company B is an forestry company, is looking to raise 5 million through the issue of 6-year deep discounted zero coupon bonds. Okay, so the issue price has been set at 40% discount to nominal value. Okay, so now the company B issue 5 million, 5 million deep discounted bond, 6% zero deep discount bond. The issue price has been set at 40% discount. Okay, so the to the nominal value. So how much is the price after discount? So if this is 100, which is generally, so if this is 100, then the issue price is after discount is 60. Okay, the Kevin maybe invested but is looking for a return of, now he's looking for return. How much is the return? He is now looking per year to do so. Okay, the bonds will be redeemed at a nominal value upon redemption. Okay, so the bonds redeemed at nominal value. Okay, so there is no premium at redemption. Okay, next is Kevin also own fixed rate bond in company C. So company C also on fixed rate bond in company. These bonds are traded on major bond markets. Kevin is thinking of selling them now as he believes that the interest rates are going to increase shortly, resulting in drop in bond price. Okay, so if bond price will decrease, so value of company will decrease. Why? Because if the interest rate increase, the value of bond price or the value of company will decrease, because we discount with the interest rate. When we discount with the interest rate, if this discount rate is higher, then our value will be lower, the value of the company. Okay, so that's why he is now selling. Okay, all three companies are at a tax rate of 25%. What is the estimated market value of Kevin's investment in the bonds in company A? Okay, to the nearest 1000. So now we have to calculate the market value of the investment in value of A. Okay, so now, so how do we calculate this? Is this is the this is the this is the this is the redeemable. The bonds are to be redeemed, so all these bonds are redeemable. Okay, so this is redeemable 1 to 5 years. They will get year cash flow. So 1 to 5 years, the cash flow will be 5, and cash flow will be 5, and for the fifth year will be redeemed. Okay, so at fifth year it will be redeemed, and it will be redeemed at nominal value of 100. Okay, so Kevin bought in company A at a price of this and redeemed at 100, and this is 5% at the nominal value. Okay, so we need to calculate the discount factor, which is at the rate of 30%. So now 30%, we have to calculate the discount factor. Okay, for this calculation we have to do because here we have the same cash flow for the 5 years, so we need to calculate the annuity factor for the 5 year. Okay, so we don't have the 5 year annuity factor because it is only up to 20%. Okay, so for the 30%, because we have the 30% here, we have to calculate the annuity factor at 30%. We don't have here, we need to calculate using this formula. Okay, so we need to calculate using this formula. Will be this. Okay, no, copy. Okay, so I will write this annuity factor formula is 1 plus, sorry, 1 minus 1 minus 1 plus r minus n r. Okay, so r is the interest rate per period. Okay, so period is 1. Okay, 1 year. So if it is period for 6 months, so period will be 2. Okay, so if it period 4, we have to take yearly interest here. Okay, so 1 minus 1.3 is 3, and we have to take 3 because 30%, and number of compounding is 5 years. Okay, so when we solve this, we will get 2.436. Okay, 2.463 is the annuity factor for 5 years, at 30%. Okay, for 5 years at 30%. So now we have to calculate the discount factor, because the cash flow 100 is only for the fifth year. So we now have to calculate the cash flow discount factor for 30. Discount factor for 30%, it is not given. Okay, it is not given, so we have to use the formula 1 plus r minus 1. Okay, 1 plus r minus n. So 1.3 minus bounding is 5 years. Now we will get the answer of 0.269. So 0.269 is the answer. So we will get, when we multiply this with this, we need to multiply it, and we will get the present value is 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 12.18 is 6.9. Okay, so now we had to add back 39.08. So it is, the value is around 39. This is the value. So we, okay, so when we convert this, multiply it with 1000, so we will get 39 39 0 800. Okay, so this is the answer, and when we round off to the thousand, so this 800 will become the 9391. So we have to round up. Okay, this is the answer. Calculate the annual return to the investor on the deep discount bond, the average annual growth rate on the bond value. Okay, so now we have to calculate the annual growth rate to the investor. So what is the G here for the deep discount bond? Okay, so the, so now we have to calculate the annual return to the investor. What is the annual return to the investor on deep discounted bond? Okay, so what is the total return to the investor, and that return is how much percentage? Okay, give you answer to the percentage. Okay, so now we have the deep discount bond. Deep discount bond. Deep discount bond is looking to raise 5 million through the issue of 6-year deep discount bond. The issue price has been set at a 40% discount to 40% discount to 40% discount to nominal value. So they issued at 60, and it will be redeemed at 100. Okay, so how much is the return? Okay, so we have to use the future value formula. Okay, future value, this is the future value that will be redeemed, and this is present value that it is issued at, and this present value will be grow at the return. We need to calculate this R, and this is the number of years of compound. Okay, so 1 plus R, and R, and this is n is how much after 6 years, so this will be 6. So now we have to solve it. 100 divided by 61 divided by 6 equal 1 plus r equal, when you solve it and you have to deduct -1, then you will get 8.9%. Okay, so 8.9% is the answer. So you just need to know the future value formula. So future value is the present value. Okay, present value, and how much is the rate at which it is compounding. So it is compounding for 6 years, and what is the rate at which it is compounding? So we need to calculate this rate, and we will get this rate as 8.9%. Okay, so calculate the discount required so that deep discounted bonds give a return to the investor of 10%. Give your answer to the nearest. So now this R is given. Now we have to calculate how much we have to give the discount. Okay, so how much we have to give the discount? Okay, so now 100, we need to calculate this. Okay, so 1 point we have given the discount rate, which is 10%, so we can write this. Okay, so now years of compounding is 6, and the present value will be you need to divide it. Okay, how can you solve this? Okay, so this PV 1.1 with 1.1, and this compounding 6, the value will be 1.77156. So now you have to divide 100 by this 1.771561, and you will get the present value. Present value will be how much? 56. Okay, present value is 56. So this is the issue price. Okay, so this is the issue price. How much will be discount? If this is issue price, so we need to deduct this 56 out of 100, so discount is 44%. Okay, indicate by clicking in the relevant boxes whether the following statement concerning deep discount bond are true or false. Okay, it is illegal for companies to issue bonds at discount. No, because if it is illegal to issue bonds, so why the deep discount bond concept is introduced in the finance? So deep discount bond can be issued. Okay, so deep discount bond can be issued, but shares cannot be issued at discount. Okay, this is false. Okay, now the deep discount bonds can help company be cash flow. Okay, so This is correct because the deep discount bond initially don't pay any. Okay, so initially deep discount bond in deep discount bond. So how deep discount help company to manage the cash flow? So help company because in this company, this is a forestry company, and in this company the initial investment is required. First the initial investment is required for the seed plantation and the growth of the plantation. So buying the plant, the seed, watering, so all these required the investment. Then these plants will grow, so there is no income in between. Okay, so there is no income in between, and then we will get the income by selling the plants. Okay, so here we issue the deep discount. So when we issue the discount, it will be issued at discount, so we will get the amount for the initial investment, and in between we don't have no income in between. So there is no payment we have to do because we don't have to make any interest payment, because these are zero coupon bonds during the 6 years. Okay, during the 6 years we don't have to pay any interest on these bonds. So this no income, because we don't have no income, so we cannot pay the interest. So the cash flow, this help us. Okay, so next, at the end when we sell the plants, we will get the money and we will pay the redemption value of the zero coupon bond. Okay, so when we need the amount, we get the amount. When we don't have the money, we don't need to pay the interest. And when we have to pay the redemption value, we will get the value after the selling of plant. So the stage of the forestry company, the investment, the cash flow required match with the deep discount bond, so it will help company to manage the cash flow. So this is true. Okay, next is investors required return will generally be lower with deep discounted bonds. So investor required return generally lower than deep discount bond. No, because deep discount bond is, there is no connection between deep discount bond and the investor return required. Okay, so investor required return is depends on risk. So how much risk the investor is taking, so their return depends on the risk, not the deep discount. Okay, so this is false. Next we have the which two of the following statement concerning bond price are true. Okay, so the price of the bonds with fixed coupon rates will not be affected by changes in interest rate. The value of the bond of fixed coupon bond will not affected by the change in interest rate. No, because the price of the value per share, value per bond is the present value of future cash flow. Present value of future cash flow. So this future cash flow discounted at discounted at discounted at investor required return. This future cash flow discounted at investor required return, so we will get the present value, and this present value is the value of the company. So if this discount rate is the interest rate, and if the interest rate increase, this cash flow will decrease and the value will decrease, and vice versa. Okay, so this is wrong. Change in expected inflation level will not affect bond price. No, because in inflation, change in change in required return. So they, if the inflation increase, the return they are expecting will also change. Okay, so the market value will change. Okay, change in bond value will result in change in bond value will result in changes in the return required by investors. This investors in those, no, changes in bond value, no, changes in return required, changes in return required will lead to change in bond value, not the changes in bond value will lead to changes in required return. So the statement is opposite, so this is wrong. Bond prices typically falls as as the the interest rate rise. Yes, this is true. We understood this here, that if the interest rate increase, the value of the company decrease the price. Okay, the bond price will decrease. Okay, so the next is the market price of the bond may not be same as theoretical value. Yes, because at because the theoretical value will be same as market value in case of perfect market. In case of perfect market, the theoretical value will be market value, the market price. Okay, the theoretical price will be the market price, but the perfect market do not exist, because because investors investors do not always take rational decisions, because investors don't take rational decisions always. So the perfect market do not exist and the investors make irrational decision, which is the herding herding okay, bubble herding bubble, loss aversion. These type of decisions, when they take these type of decisions, the market price cannot be the theoretical value, and this price only exists in case of perfect market. So perfect market do not exist. Next is Loki. Okay, so next question is Loki company. Loki company is growing company specializes in making accessories for the mobile phones and tablet. Okay, the company is currently all equity financed with 2 million ordinary shares in issue. So there is no debt in this company and only 2 million shares. The existing shareholders are mainly family members are the shareholders, and the friends, the directors of Loki need to raise finance to fund a new factory. Okay, so directors wants to raise the finance and are considering to range of options including flotation and venture capital. Okay, future growth is anticipated to be the following. Okay, so future growth anticipation are these: earning next year, this is the earning E1, this is the dividend next year after 1 year, and after 1 year this will grow at 7% earning. and this dividend after 1 year will grow at 4%. Okay, and we have the options here for raising the funds. Okay, for the flotation Q company or flotation Q company, a listed company within similar business activities to Loki has a PE ratio. This is the PE ratio of Q company. Okay, and equity beta. This is the equity beta of Q company, and gearing measured. This is the debt to equity. Loki is expected to grow faster than Q company, at least in the short term. So Loki will grow faster than the Q company in the short term. This is not relevant here. So if flotation is approved, then the share price would be set at 15%. Okay, so share price would be 15% discount to fair value. So if flotation approved, so each share price will be issued at 15% discount. The directors of Loki do not believe that an asset valuation is much of use here. Okay. So next is the venture capital. The directors of Loki have been in discussion with 40 a listed venture capital company as well as contributing equity. 40 would seek to spread the risk. 40 seek to spread the risk risk of their investment by also investing in form of 4-year 5% secured redeemable bonds as well as convertible preference shares. So the directors of Loki have been in discussion with 40 a listed venture capital firm as well as contributing equity. 40 would seek to spread the risk. 40 seek to spread the risk of their investment by investing in the 4-year 5% secured loan note, secured redeemable, spread the risk of their investment by investing in the form of. So this company would just spread the risk by investing in secured redeemable bonds as well as convertibles. Okay, the risk adjusted return for the similar bond is 6%. The current tax rate is 30%. Which of the following statement concerning usefulness of asset based method valuation is correct? Okay, so which of the following statement concerning the usefulness of asset based method valuation is correct? Okay, so for which company the asset based method, for which statement is correct about the usefulness of the asset method? Okay, so replacement cost is normally represented the minimum price that should be accepted for the sale as a going now, because the replacement cost is the duplicate. It means that if you want to buy the similar asset, or if you want to buy the same asset, if you want to start the same business, so how much does it cost? It is a duplicate price. Okay, not the minimum price is the NRV, so this is incorrect. Next is breakup value. Breakup value should provide a measure of the maximum amount that any purchaser should pay for the business. Breakup value should provide a measure of maximum value. Breakup value provide the maximum amount that a company should pay for the company. No. Okay, so breakup value is not the maximum. Breakup value is how much amount received when selling assets separately. So if single asset is sold, so how much it is worth? So this is called the breakup value. Okay, so the breakup value is not the maximum, instead the replacement cost. What is the replacement cost of that asset is same asset plus any modification is the maximum that a buyer pay for that. So breakup value is not the minimum maximum, instead it is the minimum value. Yes, this is the book value will normally be a meaningless figure as it will be based on historical figure. So yes, because book value is just the starting point. It is just the starting point. The book value in accounting does not necessarily correspond to, so book value is not real value. It is not real value of the company, so it's irrelevant for any. And this book value can change by the accounting policies, okay, and the estimates. Okay, so it is based on historical values, historical it is based on historical values, and this is this is this is can be manipulated by accounting policies and estimate. So this is incorrect. Okay, next is asset based method give consideration to non asset based method give consideration to non-statement of financial position intangible assets such as a highly skilled workforce and strong management team. So asset based method do not consider intangible assets, so this is wrong, this is incorrect. Calculate the value of Loki company equity beta. So now we have to calculate the equity beta of Loki company. Okay, so this is our company, the Loki company, and we wants to raise finance through the flotation and venture capital. Okay, so for the flotation we have given this company, a listed company, which we want to use for the calculation of beta equity. Okay, so for this company we have the Q company listed with similar business. Okay, so we have the Loki company and Q company has similar business. Okay, so Loki company PE ratio is given, this is PE ratio given, and the beta equity is given. Okay, so and gearing beta equity is 1.2 and gearing measured as, so this is debt to equity ratio is given. Loki is expected to grow faster than Q company. So Loki will grow faster than the equity, at least in the short term. If flotation is approved, then the issue price would be 15% discount to fair value. Okay. So the directors of Loki do not believe that an asset valuation is much used here. Okay, so now we have to calculate the beta equity of our company. Okay, so we have given the beta equity beta of another company. Okay, so let's do this. So let's first understand that what is equity beta and what is asset beta. Okay, so equity beta is when a company is financed by equity plus debt. When a company is financed by equity and debt, so its risk, the metric for measuring the risk is beta. So its metric for measuring the beta will be beta equity. Okay, but if a company is financed only by the equity, there is no debt. Okay, so if the finance is only by the equity, then it will be asset beta. Okay, asset beta. Okay, so you have to remember that equity beta when a company is financed by equity and the asset, and the asset beta is when a company is financed only by the equity. Okay, so now one more thing you need to understand, that if a company is financed by equity and debt, okay, so this debt is also known as gearing. So if a company is financed by, this is called gearing. Okay, that is also known as gearing. So this asset beta is, equity beta will be, this equity beta will be geared beta. Okay, geared equity beta, and this asset beta will be ungeared because there is no debt, so ungeared asset beta. Okay, this one more thing you need to understand. Okay, so now we have to calculate the equity beta of Loki company. So now to we have to ungear this company, because the equity beta is given. So equity beta is given, this is given, and this includes debt and equity. Okay, but our company is all equity finance. So all equity finance only has, so this company, our company will have the asset beta, but here we have given the equity beta. So now we have to convert it into equity beta. Okay, sorry, asset beta. Okay, so now we have to de-gear. So we need to remove this debt. So this is known as de-gear. So de-gear or ungear to equity beta. Okay, need to ungear to equity beta. Okay, so you need to ungear this. You need to ungear this equity beta. Okay, so how can you ungear? You need to ungear by this formula. One. This is also given in your formula sheet, so you don't need to remember value of equity, value of E plus value of debt 1 minus T. Okay, okay, so this is also given in the formula. Asset beta is this, and we don't do this, we don't consider while calculating the formula. This formula we don't consider this value because this is risk free. We assume this is risk free. When it is risk free, the effect of this will become zero or nil. Okay, so the formula only is this. So in order to calculate the asset beta, we need to use this formula. Okay, okay, so asset beta or the ungeared beta, because our company is ungeared because we don't have the debt, and this company has the debt and it's given the equity beta which includes the debt. So now we have to remove the effect of debt, so we need to calculate the asset beta. So we are calculating the asset beta and removing the effect of debt. Okay, so now beta is 1.2 and value of equity is 0.2. 1.2 and value of equity is 0.2. 1.2 and value of debt is 1 minus 3. Okay, so now we have to remove the effect of debt. So we are calculating the asset beta. So we need to calculate the asset beta and remove the effect of debt. Okay, so now this is debt and this is equity. Debt is 1 and equity is 2. Okay, this is the ratio we have given, or also called the value. 2, 2 plus 1, 1 minus. What is the tax rate? Tax rate is 30%. 30%, so 0.3, and you will get the answer 888, or I can say that is 0.89. Okay, so this is asset beta. Sorry, this is asset beta, and asset beta is ungeared beta without debt. Okay, so now this is the beta of asset beta of Q company asset beta, which is ungeared. So because we have the similar business, okay, so we have the similar business, so we can say that this asset beta is the this asset beta is the our company asset beta. Okay, so this asset beta is our company asset beta. Okay, and this asset beta is Loki company asset beta. Okay, and Loki company have no debt, because Loki company has no debt, so this asset beta is equal to beta. Okay, so this asset beta will be equity beta as well, because our company, the Loki company, don't have the debt. Okay, so this will be the answer 0.89. The next question is calculate the issue price. So we need to calculate the issue price of Loki shares for the flotation to the nearest cent. Okay, using the dividend valuation method. Okay, so we need to calculate the P0, that is the issue price, the price of the share, and K is given, so dividend valuation method will be used. So D1 or D0 1 plus G and KE minus G. Okay, so D1 is D1 is 0.14 KE, 4 minus the growth is given here 3%. Is million, and this we give the discount of info. Okay, so this is the million, so, and this is the total value. Okay, so we need to calculate the per share value. Okay, so per share value will be 2 million ordinary share, 1.2 divided by 2 equal per share price is this, and out of this we have to give this at 3% discount, so the price will be 595 million per the issue price. Okay, next is market value per bond of the redeemable bond, the two decimal. Okay, so you need to calculate the value of redeemable. So redeemable bond is E1, also invest in the form of 4-year 5% redeemable bond, all convertible as convertible preference share. Okay, so you have the option to convert it into preference share. Okay, no, redeemable bond as well as convertible preference share, so this is separate. Okay, so and we don't have any information about this. So the for the 4 years 5, and at the 4th year we will get the redeemable of. Okay, so we have the this can just return for the similar bond, which is 6%. So 6% at 6% you will get return 6%, you will get the return how much. The annuity factor will be 3.465. I have done so many questions like this before, so please solve it by yourself. I have done many. So 6.5 the value of per bond. Which two of the following statement concerning 40 perspective are 40 investment in the preference share will have the lowest risk out of three methods of finance due to option to convert. Due to option to lowest risk due to option to convert. This statement is wrong because the lowest risk is debt. In case of debt, we have the lowest risk because that is secured against the company's asset. Okay, so that has the lowest risk. So this is incorrect. Next is 40 will accept a lower level of dividend on the convertible preference shares compared to normal preference shares. When you have the convertible preference shares instead of normal shares, you can accept lower dividend because you are getting the benefit of conversion. So statement is correct. Okay, and the next is 40 is likely to prefer to use CAPM in valuing Loki shares. Okay, 40 is 40 is 40 is a venture capital. 40 is a venture capital company, and generally the venture capital companies invest in invest in invest in different companies to diversify risk. Okay, and in CAPM we have the we have the we have the assumption that shareholders have shareholders in CAPM we have one assumption that shareholders have diversified portfolio. Okay, so diversified portfolio. So for the that's why they likely to prefer to value using the CAPM. So this statement is correct. And the next is will be wrong definitely because we already have two correct answers. So for the current shareholders of Loki would be willing to sell majority equity stake to 40. The shareholders are the family members, and family members do not generally sell the majority stake to anyone. Okay, so this is wrong because the family depend on the business for their earning, for their day-to-day expenses. Okay, that's why they don't sell the majority stake to anyone. Okay, so next is have. Okay, let's start this question. The Davina MC NAV is a fund manager within MINC. Okay, and MINC is a investment company. Okay, MINC is a investment company which is listed on the global stock market. Okay, it's a listed investment market company who is MINC. Okay, she has recently, and Davina is the fund manager of this company. Okay, she has recently identified the following potential acquisition targets. So now the acquisition target she has identified is company A, company B, and company C. Okay, so company A is an unquoted, so this is not listed company, unlisted, unquoted property development. Okay, so it's a property development with portfolio of over 200 houses. So this company has 200 houses which are under the stages of renovation. Okay, it has been loss making, so this company is loss making from last 2 years due to economic downturn. Okay, so Davina believes that due to new government legislation, this will boost the housing market and the economy, and the company will be profitable. Okay, that's why he want to acquire this company. Okay, next is B is also an unlisted, which is a shoe manufacturer company. It has also suffered the recent recession, but the directors also confident. But directors are confident that company in the past the worst. So the worst time has been passed. Now the growth will be ahead. So now the growth is ahead. So earning is next year. This is E1. So this is E1, and this after the year one, this will grow at 2% after year one. Okay, the earning. Okay, next is dividend. So dividend will be this for the next 3 years. So for 1 2 3 we have the dividend. How much we will have the dividend of 5, and this will grow at 3%. Okay, so Davina has located a similar listed company that has an earning yield. This is the earning yield, and the cost of equity is this. Okay, now the next is company C. Company C is a listed company. Okay, company C is listed, which is fashion retailer. Devana believes that current share price, this is the current share price, and this current share price is undervalued. Okay, and making it a suitable target. That's why she wants to acquire. She is also interested in company C as she feels it would have a good fit with her existing fund portfolio and would diversify away the risk. So this first company is property development, the second is shoe manufacturer, and the next is the fashion retailer. So she wants to acquire this company, the fashion retailer, because this diversify the risk, because these are in recession, but this company will be in profitable. Okay, that's why this diversify and any risk will be mitigated. Okay, so now we have the question: which of the following valuation methods suitable for company A? Okay, for company A, which method is suitable? So company A is unlisted. So if unlisted, so in unlisted there is no price, right? There is no price, no price. So this is the price divide earning. So no price in unlisted, no price in unlisted. So this cannot be used. So dividend valuation method. So dividend valuation method because there is there is recent and future. There is recently recently he is making loss and may make loss in future as well. So if it is loss making, so no dividend will be given to shareholders. If no dividend is given to shareholders, so the dividend valuation method cannot be used. So net realizable value of assets. Okay, so because this is a property development company and it has lots of tangible assets, and this NRV is the method of net asset based method. So we can use this method. So this method can be used here. Okay, so this method can be used in this company. Okay, and next is market capitalization, because the share price is not, this is not listed company, so share price, market capitalization is share price multiplied number of shares. So because this is unlisted company, so there is no share price, so this cannot be used. Okay. Calculate the value of company B by reference to its predicted earning in million dollar, okay, to one decimal. So you have to calculate the value of company B using the earnings. Okay, so we have the formula for earning, which is earning 1 plus G if growth is given, and KE minus, sorry, the earning yield minus G. Okay, so earning is 12.5, E1 is 12.5, and earning yield is 0.12 minus E 0.03, 0.02. So the answer is 125 million. Next, we need to calculate the value of company B using DVM, dividend valuation. So dividend, we have given dividend, and this dividend will be for the next 3 years. And in the from fourth year, then after, this is up to the 3 years, and from fourth to infinity, this will be 5 plus 3% every year. Okay, fourth to infinity will be 5. Okay, so to calculate the infinity, we have to divide this by have to divide this by cost of equity, cost of equity minus the growth. So the value will be the okay. So fourth year, from the fourth year, this will grow at, the dividend will grow at 3%. So this is the fourth year dividend. Okay, so in the down we have deducted the growth. Here we plus the growth. Here we deducted the growth. So this dividend is the year 3 dividend. Okay, so and this will be the at perpetuity. Okay, so when we solve this, so we will get the dividend, which will be the value of dividend for the perpetuity at year 3. Okay, so the value of dividend at year 3 till perpetuity. So now we have to discount this with the 14%. So this is the 14% discount rate we have to take here. So for the 14% discount rate, we have to take 14% for the 3 year, 0.675. We will get the present value. Okay, so here for 1 to 3 we will get the value of annuity, which is which will be for 14% for 3 years, for 14% for 3 years, 14% for 3 years, 2.322. Okay, this is the annuity we have to take because the is constant. We have to multiply it to 2, so we will get 11. So when we add back amount, the total will be 43.21. This is the answer. Next is, which of the following statement concerning Davina opinion that company C is undervalued? So why Davina feel that company C is undervalued? So we have to find the reason, and region must be which is the true region, correct region. So Davina believes that the stock market is strong form efficient and she has access to secret information. No, because in secret information, in strong form efficient, you have the share price. The share price reflect past information plus present plus any future which is inside information. Share price reflect all information and share price at its actual price. So share price is at its actual price. So it cannot be undervalued. So this is incorrect. Vina believes that stock market is semi-strong form efficient and she has access to secret information. Yes. In this case, we only have the share price only reflect the past plus any present which is published information. So past share price movement will reflect in the share price. Okay, so you cannot make any profit by studying the past share price movement, and the published information will be already reflected in this share price in a semi-strong market, but any future or inside information not included. So if you have this secret inside information, you can make the profit, and this can be the reason the share price can be undervalued. Okay. So next is Joanna believes that the stock market is semi-strong and has analyzed the financial statement and press release, which is published information. This is past or published information. Published information, when you analyze published information which is already reflected in the share price, so which is already incorporated. So this cannot be the reason for the undervaluation of share. Joanna believes that the stock market is weak form, and she has produced graphs of historical prices to for her opinion. So in weak form, you cannot make profit by studying the past share price movement or past information, because past information already reflected. So this is also incorrect. This is only the correct answer. Indicate by clicking in the relevant boxes whether the following statement concerning whether Davina should buy company C to diversify away portfolio risk. Okay, so the shareholders of MINC are unlikely to value such diversification. Yes, because because the shareholders because the shareholders already diversify okay, when we calculate the KPM, we assume that the shareholders are already diversified the risk, so only the unsystematic risk, which is specific to the company already diversified. Okay, I will explain this. The systematic risk is general risk, and unsystematic risk is specific risk to a company. Okay, so this specific risk, unsystematic risk, is diversified by the shareholders. So the shareholders of unlikely to likely to value such diversification, because the company is diversifying the specific risk, because these companies property, shoemaker, and the fashion, these companies are specific these risks. These companies have the specific risk, but the economic downturn will affect it both companies, right? So this systematic risk, which is general economic risk, cannot be diversified, but this unsystematic, which is specific, can be diversified, and which is already done by the shareholders. So if you do by yourself, the MINC is unlikely to value such diversification. So because shareholders are already diversified their risk. Okay, Joanna should also always try to reduce the average beta of her portfolio. Average beta of this statement is Joanna always try to reduce the beta. Always reduce the beta. Beta is measure of risk. So Joanna should reduce the risk. No, because if the risk is increased, no problem, but the return must be increased. The return must be increased. Okay, so if the risk increased, the return should be increased. So you should not try to reduce the risk. Instead, you should try to find the find the investment where if the risk increase, the return will also get increased. So this statement is false. Okay. Next is China should seek to diversify away any systematic risk, which is general risk. So general risk cannot be diversified. So general risk, general risk is affected to which affect all companies like economic downturn. So this cannot be diversified by using the portfolio. So this cannot be diversified. So the general risk cannot be diversified. So this is incorrect. False. Next we have the question. Okay, so next question is Pike Company. Pike Company is a listed company and it's a conglomerate and is looking to buy. And this Pike Company wants to buy the Minnow Company. Okay, so this company is advertising company owned and run by, and this is the owner. This is the owner of Minnow Company. Owner is Freda Minnow. Freda has agreed to sell. Freda has agreed to sell and has insisted on cash consideration as he wishes to retire. So Freda will sell and take the cash in the consideration. Okay, as he wants to retire. Okay, so Pi company is considering issuing bonds to generate the cash required. So now the Pike company will issue the bonds so that he can receive the cash, and then out of this cash he will buy the Minnow and pay in cash. So buy Minnow and pay in cash. Okay. So we have given some information, the statement of financial position for Minnow company, net book value of assets, net realizable value, book value, replacement cost, and the bank loan. Okay, statement of profit or loss we have given the Minnow company, the profit for the year after tax of 7 million last year, expected to grow. So this is P is profit at 0. We can say that it is now, and this will grow at 3% every year. Despite owning and running the company, Freda now does not take any salary. Okay, so despite owning and running this company, the Freda may now don't take salary. Instead they prefer to take the money as a dividend. Okay, so Pike company estimate that it will offer a salary of 100,000 to replace Freda when she leaves. Okay, so Pike company will give salary of this to Freda to replace it. Okay, next is we have the cash flow. Pike company estimates that after making a number of changes, Minnow company will generate free cash flow of 6 million next year. Okay, so after generate free cash flow 6 million next year and grow at 4% per year thereafter. Other information: Trot and Company is a quoted advertising agency with similar gearing. Okay, so it has same gearing, same debt ratio, growth prospect to Minnow. Okay, so and Minnow and Trot has same debt ratio for gearing. The P ratio we have given the WACC, the cost of equity for Trot company. We now pays the tax rate. This is the tax rate we have given. So based on these information, we have asked one question. So based on the asset value, what is the minimum amount Freda should accept for the equity minimum amount Freda should accept for the equity of Minnow. So what is the minimum amount? What is the minimum value of Freda company? So minimum value is NRV based on NRV. Okay, so NRV is net realizable of assets is 13.7, but this is the only for the assets. Okay, but we have to deduct the liabilities as well. So bank loan is 2.5, 13.7 minus 2.5, 13.75, we will get 11.2. Sorry. Okay, next is calculate market value of now using earning. Give your answer to nearest. So we have to calculate the value of the now company using earnings. So earning side, we will get the market value. Okay, we need to calculate the value based on earning method. Okay, and so we have given the earning, and this is last year profit. Okay, so we have to increase it for the current year. Okay, so 1.03. Now out of this we have to reduce the salary. We are paying paying this, and this salary must be after tax. Okay, so this will be the cash flow 714, and PE ratio is 7. Ratio is P ratio will be the 7. Okay, so P ratio is 7. Okay, so we will get answer which is nearest million, so it will be 3 million. Calculate the market value of equity. Calculate the market value using dividend discount. Discounted cash flow. For this, you have to take the discounted cash flow for the now company. Okay, for this, we have the cash flow. This is cash flow we have given. Cash flow is 6. Next year, this will be 6, and this expected to grow thereafter. Okay, so after this will grow uh, till perpetuity. Okay, so this is the cash flow after 1 year. Okay, so it has the growth, has growth. Okay, so now we have to we have to we have to we now will divide it by WACC. Okay, so divide it by WACC and deduct the growth rate, which is 4%. Now we have to solve it. 75 million. This value is for the debt plus equity. Okay, so this value is for the debt and equity. But from this value, we have to calculate the equity value. So we have to deduct the debt value. So we have to deduct the debt value. Debt value is 2.5 million. We have given here. So 5 is 7. Next, which two of the following statement about proposed acquisition is true? Okay. So Freda probably prefers to take dividend due to tax consideration. Yes, generally what happens that the dividend taken by the Freda is mm, is the owner, the Freda who run the company. So the dividend that is taken by her by them is to save the tax. Okay, so this is correct. Generally, the decision to take the money, how to whether you take the salary or take the dividend, is generally because of tax consideration. Okay, so in order to save tax, the owners take either dividend or the salary. Okay. So this is correct. Next is a major risk faced by a bike company is that customers will be loyal to Freda rather than the company. Yes, Freda will retire, but generally in small companies, the customers are loyal to the managers, the owners, and the company, so may leave when she retires. This is correct. If the stock market of five company is listed on is strong form efficient, then the share price of Park will only react to acquisition when the confirmation is published. Now, in a strong form, all the information will get reflected in the price. So not when it is published, it will be also the inside information. So this is directors of pie company should only be concerned about the unsystematic which can be diversified by and the okay. So specific risk can be diversified by investing in different companies. So directors should not be concerned about this. Instead, they should be concerned about the systematic risk, which is general risk. Okay, this is wrong. Next is which of the following statement concerning the use of different valuation method is true? Different valuation method is true. Asset valuation are unlikely to give good consideration of market value. Asset valuation, asset valuation not give good indicator of market. So asset valuation is not a good indicator of market because 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 if company is a service based organization, service based company, so intangible assets will not be accounted in the asset valuation method. So asset valuation is unlikely. Asset valuation is not good indicator of market value. Yes, this is correct. and here our company is advertising company, which is a service company. Okay, so they provide the service of advertising, so they have the lots of intangible assets. Okay, like goodwill and patent. So you know, this is not good indicator. Next is theoretically discounted cash flow approach are the best. Discounted cash flow method are best method. Yes, because discounted cash flow based method would include future value. Include the future cash flow. Future cash flow. So future cash flow or value, it include all the value, all the value of. So when it includes the all the value of a company, all this is a method, right? Good method, and it is superior to other method. So this is the best method. Next is we have dividend DVM, dividend valuation model using historic dividend would give a fair market valuation of the dividend. Do not give the fair market valuation because dividend change every year and dividend is not given if no profit. Okay, also dividend valuation method is less useful for majority stakeholders. So anyone who wants to take the more than 50% shares, so they want to control the business. So when they want to control the business, so they want to run the business. So when they want to run the business, so they are not interested in the dividend. So dividend valuation method is not useful for the controlling interest of the shareholders. So this method is only useful for minority and not useful for the, so it is not useful for everyone. So this method is not good. Only and to each. Hey everybody, my name is Neeraj Sen. Thanks for watching. If you are benefited from the lecture, consider like, share and subscribe. If you have any questions, leave them in the comments below. I will meet you in the next video.